You know, every single investor is in this constant battle, and it's not really with the market, it's with themselves. It's this classic tug of war, right? Between the logical part of your brain that knows the plan, and then fear and greed, these emotional impulses that are always trying to throw you off course. So how do we actually win this fight? Let's get into it.
So let me just ask you this straight up. What do you think is the biggest single threat to your long-term investing success? A recession? A massive market crash? Picking the wrong stock? Well, I bet the answer isn't what you're thinking.
Okay, so check this out. The data is pretty eye-opening. MFS did this research that shows over a 30-year stretch, the S&P 500 returned over 10%. But the average investor, they got less than half of that. So why? What's with the huge gap? Well, it's us. We tend to get greedy and buy high when everyone's excited, and then we panic and sell low when things look scary. The biggest threat to our portfolio? It's often the person staring back at us in the mirror.
But what if you could just flip that whole script? What if you could use those huge emotional swings in the market to your advantage? Well, that is the big idea behind a strategy called contrarian investing.
This quote from Baron Rothschild, man, it just perfectly captures that contrarian spirit. I know, it sounds a little grim, but the wisdom behind it is so powerful. The absolute best opportunities often pop up when everyone else is completely freaking out.
So at its heart, contrarian investing is all about going against the herd on purpose. It works on this belief that widespread emotions, that mass fear or greed, they actually push the prices of things way off from what they're truly worth. And that's what creates opportunities for people who can keep a cool head.
Okay, that all sounds great in theory, but how on earth do you objectively measure something as, fuzzy as market mood? Well, believe it or not, there's a tool for that. Let's talk about the Fear and Greed Index. The best way to think about it is like a mood ring for the market. It takes a whole bunch of different data points, things like market momentum, volatility, trading volume, and boils it all down into one simple score, from 0 to 100. It gives you a snapshot of whether the crowd is feeling more fearful or more greedy on any given day.
Now, if you're a contrarian, you're basically reading this thing backwards. When the score drops below 25 into extreme fear, it suggests everyone is way too pessimistic, and the market might be a bargain. That could be a buy signal. And on the flip side, when the score shoots above 75 into extreme greed, it means euphoria has taken over. The market might be overheated and due for a pullback. That's your potential sell signal.
All right, theory is one thing. Let's see how this actually plays out in the real world. We're going to look at two recent and pretty dramatic examples where this index gave a really powerful signal.
Okay, first up, let's rewind the clock to early 2020. The COVID-19 pandemic was just starting to sweep across the world, and you could just feel the fear gripping the financial markets.
And by March of that year, the Fear and Greed Index absolutely cratered. It hit a reading of just 8, a single digit. I mean, that is about as much panic as you can possibly measure. Markets were in a total freefall. The headlines were apocalyptic. But for a contrarian, this extreme fear was a flashing green light. The people who had the courage to buy when there was, blood in the streets were rewarded with some absolutely massive gains over the next few months as the markets made a historic comeback.
All right, now let's flip the script and fast forward to the total opposite scenario, the euphoric, crazy market peak of late 2021.
By November 2021, that same index was practically screaming extreme greed. We're talking readings well above 90. The mood in the market was just pure, unfiltered optimism.
And this shows you the other side of the coin. Tech stocks, crypto, everything was hitting all-time highs, and the whole rally was looking a little bubbly. Contrarians saw this extreme greed as a major warning sign. So, the folks who took some profits off the table or protected their positions were able to sidestep the huge downturn that started in early 2022.
Now look, being a contrarian takes guts. And let's be honest, trying to perfectly time the market, it's next to impossible for most of us. So, is there a more accessible way to manage our emotions? Well, it often comes down to discipline over timing.
And that's where something called a systematic investment plan, or SIP, can be a total game changer. Instead of trying to guess the tops and bottoms, you just invest a fixed amount of money on a regular schedule. Say, every month. You automate it, and it takes emotion right out of the driver's seat. It's all about discipline.
A SIP's superpower is that it reduces your timing risk through something called cost averaging. And it's really simple. When the market is down, your fixed amount of money buys more shares. When the market is up, it buys fewer shares. Over time, this smooths out your average purchase price. The main downside? Well, If the market just goes straight up forever, you might make a little less than if you had just thrown a lump sum in at the very beginning.
So here's a really clear breakdown. With a lump sum, you're all in right away, which is great if you time it right, but super risky if you don't. A SIP, on the other hand, with its regular deposits and lower risk, it basically makes timing the market irrelevant.
Okay, let's get a bit more strategic and look at the whole picture here. For a lump sum investment, the huge opportunity is jumping on market lows to get potentially higher returns. The threat, obviously, is a market crash right after you invest. That can be devastating. For a SIP, its biggest strength is reducing risk through that cost averaging we just talked about. But its weakness? Maybe slightly lower returns if you're in a market that's just rocketing straight up.
So, how do we pull all of these pieces together into a playbook that actually works? Well, it's all about building a resilient strategy, one that combines the right tactics with the right mindset.
So what's the playbook? First, remember your own biggest risk, so master your psychology. Second, you can use tools like the Fear and Greed Index to help you spot those contrarian moments. Or you can just use a SIP to automate your discipline. But honestly, maybe the most powerful strategy is a hybrid. Use a SIP for your consistent, regular investing, but keep some cash on the side ready to go in as a lump sum when the index flashes extreme fear. Ultimately, the best strategy is the one that fits your goals and lets you actually sleep at night.
Because at the end of the day, successful investing isn't about chasing hot tips or trying to perfectly time the market. It's about resilience. It's about having a plan and the emotional strength to stick with it through all the market's ups and downs.
Look, the market is always going to be a roller coaster of fear and greed. That is never, ever going to change. It's a permanent part of the game. The only real variable in the equation is you. So the question isn't whether the market will be emotional, it's whether you're going to let its emotions control your decisions.